that way we get
Yeah.
wine.
So thank you, everybody, on this panel. Mike, Ezra, Matt, thank you for your on-time arrival. I appreciate that. Our wine here on the left, get from Tess. We've got it from Bread and Butter. All of our panelists will get a bottle. I'm going to take my crack at your question as I get Duncan ready for the next one. I tell first-timers all the time that there's exactly two things that venture people invest in. They invest in star founders, and they invest in products with traction. So you better be one of those two things. Be a star founder or be a product with traction. If you're not one of those two, you're going to have long odds. So with that, I want to tell you a little bit about what Duncan's going to come up here and do next. This is going to be a very different kind of thing. He's going to get through 40 slides in 15 minutes. And I'm going to tell you what those 40 slides are real quickly. If you run a venture fund, you do this really boring thing once a year called the annual meeting, where you get all your limited partners together and you do a dog and pony show, and you have a couple CEOs come in and this and that. And we decided at ours last year that we'd have Duncan give a little talk about what he thought the state of the venture world looked like. And it was such a hit with our LPs that they said, that's really interesting. Why don't you share that publicly? And we went out and we published the deck, and Duncan got hundreds of emails back. And so 6 months later, our annual meeting was in December, we went and we updated the deck with new data. And I really think the presentation you're going to see over the next 40 slides is going to be one of the most jammed-packed data festivals you're going to see about what the actual state of the universe looks like in raw numbers, not just platitudes and subjective statements. So with that, Duncan, you better live up to the billing promised.
Thanks a lot. You could have undersold it, not oversold it.
Yes.
Okay, everybody pay attention. We're going to go fast here. Let's start. Series A crunch. It's real. It's here. Let me show you the data. Okay. I looked and tried to get the best data. CBI Insights did a real scrub just for this purpose, not for me, but for the outside world. The blue is seed, the red are Series A, and they scrubbed out all the crap. There's no clean tech, no pharma, no big heavy metal enterprise type of deals. This is the type of deals we're all doing here. And what you see is what you kind of expect. Okay, there's more seed than there are A's. They must fall to the floor. But wait a minute. They're showing 2010 to 2010, 2011 to 2011. If you do a seed in 2010, are you going to raise money from A in 2010? No. You're going to go the next year. So I shifted the data. Now take a look at this. Take a look. We were in alignment for the first 3 years of this craziness. If I did this on a quarterly basis, we actually were in alignment all the way into the second quarter of 2012. Oh my God, what happened then? I'll tell you in a minute. What's happened now is the A has cooled off, the seed, these are all deals done last year. And this year, the seed is still going pretty strong. So what everybody says is a crunch is actually a cliff, and a lot of deals are about to fall off the cliff. Let me show you what happened. Okay, we all know, Facebook. Faceplant. It's a train wreck, and a train wreck in the venture markets or the capital markets looks like this. First, they hit their little wall, everybody gets upset. Groupon didn't do so well. I'm sorry, there's Zynga people here. They didn't do so well. Suddenly, the next stage after the public markets, the late stage people got FOMO chill. Now, FOMO, do you guys all ever hear of FOMO? You ever hear this word? For those who don't know, fear of missing out. So some of the most venerable names in venture capital before Faceplant jumped into deals like Facebook, like Groupon, like Twitter, at exorbitantly high valuations because they had to be in it. Fear of missing out. Now, for all of us, we should all embrace FOMO. FOMO is what creates a big tech bubble. Tech bubbles create irrational returns to you and to me. So FOMO is good. But FOMO died with Facebook in this era. Now, the chill of FOMO was immediate. I'll show you some data. The Series A guys, they sort of felt the chill from the later stage growth funds. They got cool. About a quarter after that, the seed funds began to say, wait a minute. The Series A guys are not in alignment anymore. What are we going to do? We, Bullpen, follow the leading seed funds. We began to see a noticeable decay in the quality of referred deals. They literally got into the shit. They were not sending us that before. Why? They began to hide their really good deals, bridge them, take care of them, hide them from other people to make sure they can get past this little Series A crunch. And then accelerators, you saw this news, right? Paul Graham said, 80 deals, a little too big, we'll cut back a bit. Or maybe it was 150, I forget. They cut back too, and the angel guys down here began to cut back. That's where we are. We're at the end of the train wreck. So the question is this thing going off the rails or not? I'll answer that question in a minute. Here's the immediate reaction, the FOMO reaction. You can see this from the Fenwick data. That are up rounds. This are down rounds and flat rounds. What do you see happen? Bam. Fewer up rounds, more down rounds, more flat rounds. An immediate reversion. And then it stabilized a bit, which is good news. This is data for the venture industry. What you see here is the number of deals kind of flattened to soft. The dollars dropped quite a bit. It's not like 2000. I lived through 2000. It's not quite that bad yet. I looked at other data. There's no real canonical data for venture. You got to look for your data. This just came out from PitchBook. It shows a more dramatic drop in the number of deals. You can see the drop since faceplant. And the dollars dropped, and they're somewhat easing up a bit right now. I looked inside the data. Okay, we're talking about Series A. Let's take a look. This is so hard to see. The red is Series A. This is C. There's a later stage. It's 100%, so it's all deals and how they're distributed. And what you see is, down here, seed exuberance. Through here, A was doing okay. It's increased a bit, but in the second quarter, you normally see a bit of an increase in A. There's just a little bit of a seasonality in the venture business. You know, in the third quarter, everybody goes on vacation, so you get some other deals in the fourth quarter, and then everybody goes away in the first quarter. Okay. How many deals will fall to the floor? Now, look at this chart. It's one of these crazy McKinsey-style charts. Nobody should try to understand it, but look at the following. The first bar, 2,200, 2,300 seed deals in the last 2 years. The last bar, which you cannot read, I'll read it for you. Somewhere at the low side of 994, the high side 1473. Let's say 1,000 to 1,500 are threatened to fall to the floor. So that's more than half in most scenarios. That's pretty bad. So what's the market going to do? Do you guys all remember Jurassic Park, or is that so lost in history? Who remembers Jurassic Park? Okay, good. Do you remember what the chaotician said when they asked him, is the park safe? Remember what he said? You don't understand. Life will find a way. All right, capital markets are like Jurassic Park. They always find a way, and they're finding a way around the crunch. Here's some other data. Seed follow-on, how much went to the traditional venture, how much went to the alternative world, the bullpen world, the venture shift world, our world. What you see is a demonstrable drop in the funding from the traditional world and an interesting increase in the alternative world, so that in 2012, when we still had half FOMO, it was almost the same. Obviously, I don't have data for this year, but what I'm seeing in the market tells me the alternative world may be funding more than the Series A and what would be the normal Series A round position. Okay, let's pull up and go to the VC industry. Reid Hoffman's a great man. He's made this statement. There's always this argument, and Matt Ocko, I think, talked a bit about it, but the argument always is, have things really changed? Is this time different? Or is it just cyclical or go back to the old ways? Well, there's some arguments I will make. I'm normally a cyclical kind of guy, but I think in this case, we're seeing something fundamental. This is not just major ongoing disruption. I should have written, this is the greatest disruption of the venture industry in 30 years. Let's take a look at it. So first of all, oh my God. Don't look at the slide for a minute. You guys all think it's easy to be a venture capitalist, right? It's easy. It's not. It's not easy. I'll tell you why. This is the data we get from Cambridge Association about how we're doing. Can anybody understand this? I mean, they could have done an infographic. They could have used Excel and made a chart. They give you this piece of crap. Or let me simplify it. If you had put your money in a spider fund, an ETF for the S&P in 2000 or 2001, look what you have made in returns. If you put your money in all those great traditional venture funds, your returns would have sucked. Would you rather take 30% with no overhead and no brain damage, or 13% and you had to pick the right funds? Anybody? As a consequence of this, the venture industry has been consolidating rapidly. And this is the best data I found. This is data of active venture funds. There's a lot of venture funds that exist, but they don't do anything. They're sitting on money gathering fees. You can see how much it's collapsed. And venture funds don't die immediately. They have 10 years of money, so they linger on and they do a little bit and they putter around. But these are the active funds right now. And we look inside this number. This number is a little over 200. It includes both the new breed of seed funds and the old traditional funds. We have actually seen other data which says there are only around 85 traditional fund managers in the United States still really active, when that number was 1,000 way back in the good old days. And we've also seen from the deal flow we get at least 85 seed funds or something like it, more than just a wacko angel, but an institutionalized group. So we think that the new breed is actually equal to the old breed, and there's somewhere in the range of 150 to 200 existing fund managers now, but that's a real drop from where it used to be. But is that bad news? Not really. The second thing that happened here, lean finance revolution. I'm sure you guys have been exhausted with all the lean finance, lean startup crap, product market fit. I won't repeat it except to say this. If you were a venture dude, and I'm sorry ladies, they're almost all dudes, it's really tragic. If you were a dude back in 1999, you would think you needed $5 million to start a company. And you had to go to a traditional venture fund and get your $5 million A round. By 2005, in the Web 2.0 era, it was about $500K. Why? Open source, cheaper hardware. In 2010, it was $50K. Two girls or guys in a dorm room could start a company, rent it on Amazon, and launch it. Really cool. This is what made a profound change in the venture business. Now, the guy I think really got this more than anybody else, Josh Koppelman, so I'm going to celebrate him for a minute. He sort of understood that when the A round was no longer 5 million, but now maybe 500K, you could play venture a different way. The old way of playing venture, we're a life cycle investor. We'll stay with your company for 7 or 10 years. We'll make sure you get a good exit, okay? The new style, what the hell? We don't know if you got a good idea or not. It's just an experiment. We're going to buy an option, give you 500K, go see what happens. You know, if it fails, why don't you give up fast, do something better? Don't sit here and beat your head against the wall. This is a different attitude for venture, and it fits this model of lean finance. And it's hyperactive. Traditional venture fund about the size of Josh's fund would do maybe 4 deals a year. He does 40. I've looked at data on the hyperactive funds versus non-hyperactive. This is the pace you need to be an option buying type of VC like Josh. It's not really that many over the last 5 years. Most people are still in the traditional way, but these are the funds that are driving the business right now. And these funds have seized the front end of the process. We all talk about getting to the A round. Isn't that what we should be doing? Well, actually, the seed round is a new A round. That's the first institutional money in, which is what the A round used to be. And if you get that, you're in a whole different ballgame than if you don't. What happened to this whole business with lean finance, take a look at this data. It used to be the deal size was around 4 million. Seed, A, everything all thrown together. Recently, it's down to about 2.5, going down to 2. What does this do? Let's say you're a manager of a $600 million venture fund, and you have a bunch of partners, and you could do a lot of deals at $1 million. Okay, do I want 600 deals in my portfolio? I have to hire a lot of other people to run my portfolio. No, I don't. I don't want to really do these little deals. I want to put at least 5 in, if not 10, so it right sizes to the size of my fund. So the big funds had to move later. They had no choice. They couldn't do the $1 million seed round. They couldn't really do the round after, 2 to 3 million. There's just not enough room in it for them. They need to wait for the $5 or $10 million round. Now that created this alternative venture industry. You can see accelerators, super angels, micro VCs, a lot of these names you know, Bullpen's up there. This is the new industry taking advantage of the structural change in the venture market. We started Bullpen. This, by the way, is native advertising, just for a minute. We started Bullpen because we anticipated this 3 or 4 years ago. We saw this coming. And so we now see the market a little bit differently. So what people really need is a small round to follow the seed round. If you get it right, then you can go raise a bigger round, $10 or $12 million, and I call it a shovel-in round. You sort of bypass what the A used to be. You still go to the A funds. They have $600 million. They'd rather write a $10 million check, but you don't think about the process. I got to get to the A round. No, you think about the process. Product market fit, can I validate my business? Do I deserve the shovel-in money? Then go get it. And then you go like crazy and grow as fast as you can. All right, prognosis going forward. I've got 2 minutes, a 2-minute warning, I guess, from the hockey game here. Let me go fast. First of all, here's the good news. The train wreck is really over. Oh my God, not one of these charts again. First thing I'll tell you about the Cambridge Associates chart, venture returns are improving for the first time in 10 years. What does this mean? Venture returns are improving and there's fewer funds. Guess what that means? The liquidity ratio, money into, money out, is improving as well. This is making venture a better business. It's been right-sized. Okay, public markets. That's what a bubble looks like. The blue line, the NASDAQ. The black line, the S&P, the broader market. That's FOMO in a graph. What happens here? The NASDAQ has greatly outpaced the S&P just in the last few years. This is the signature of money rotating into our world. And it's what we should be seeing right before we go through another wave of wacko IPOs. Exits are getting better. You can see here the numbers increase and the dollar size increase, and there's been some pretty big numbers. If you look at 2013, recent data, the red are IPOs. 22 IPOs in the second quarter, more than any quarter in the last year and a half. And then the Wall Street Journal came up with this. So that, they're not one to miss a trend. That's the headline. Do you guys all see this? I think it was just last Sunday or 2 weeks ago, the new wave of IPOs. What the data says is this. In the first half of 13, more IPOs happened than any of the first halves after 2007, and we were in a huge housing bubble. So if you project this out, we should have the best time for IPOs since back in 97, 98. So the best way I could summarize where we are right now, it's 1997 going to 1998, guys. Hold on to your wallet or something. This should be a lot of fun. Thank you.